Well, gentlemen, we have 25 minutes for today's discussion, and I would appreciate if everyone keep your answers, succinct and sharp. And we will also be opening up to the floor, so you also will get a chance to ask our speakers any question. Please give us your name, the company, the question, and who you want to answer that question. So, let's start today's discussion. The global economy, we know, is experiencing a number of shifts. On one hand, central banks in the United States and the Eurozone, they're discussing plans to exit quantitative easing. And then the Fed has announced that it will taper the size of its balance sheet, and it may even consider another rate hike this December. It's just next month, while the ECB, is expected to announce its plans as early as the first quarter of next year. So what are the implications for APAC? Will corporates find it harder to meet their financial obligations? In fact, can higher input costs be passed through onto consumers? How can companies prepare to face up to these challenges? I'll have my esteemed panelists and speakers help us maneuver and understand what's actually going on. And so why don't we start the ball rolling? I'm going to start with you, Vivek, first. The last few years, since the global financial crisis, as Carlos just reminded us, 20 years, it's seen unprecedented turmoil, which has impacted, not just the demand for goods and prices of commodities, but, also on the liquidity and the cost of financing for corporates. So how do you see that evolving over the next couple of years, with the Fed just signaling perhaps, this December, there's going to be a rise in rates?
Sure, thanks for that. Just a quick introduction. Capital and Credit Risk Manager, the company I represent, it's a fintech platform for secondary market distribution of trade risk. Now, the reason why I say that is because in this particular role, we've been having a lot of discussions with banks, insurers, to as a part of getting them on the platform. And that's given us a very good sense of where the market is headed on the ground. So just 2 points on the question. One is, if we look at what is the cost of funds for banks when we speak to them, the sense we get is across the board, while banks have reported a higher cost of funds, which effectively is a direct impact of the liquidity pressures which they're facing, but that is not something which is uniformly true across all banks. So different banks have different pressures, and depending on which region of bank belongs to, for example, the European banks probably are reporting more of a pressure on the cost of funds, the Asian banks are not. So that sort of ties in with some of the discussions we've had during the day, where the stimulus by the central banks in the region, they're propping up the, or sort of giving more stimulus to the banking, to the banks or to the economy. So that's one. The second important point, which sort of comes or which has been a feedback from a lot of players, is that banks are still very, very hungry for assets. So the issue is not so much as the cost of liquidity, but the issue is more around banks not having access to the right credit quality or the right asset type. So that's really where it's not so much as a liquidity or a cost of liquidity. It's more about having the right kind of asset or the right kind of credit risk which the banks are willing to take.
Okay, well, Nicola, why don't I bring you in? So are banks advising their clients about the risk of higher financial costs?
So I think it's an interesting topic, and besides the interest rate environment, there are a number of other costs that impact the bank and can have repercussion on the client, and in particular regulatory costs. And it's an evolving landscape, definitely not driving towards level playing fields. And the way I view it is there are probably two different types of costs. So if you think about it, there are higher level of minimum capital requirement, stress test level, compliance requirement, and those in my mind are all meant to strengthen the financial strength of the financial system and the resilience of banks. I think clients will have limited appetite for sharing the burden of those costs. It's really for banks to adjust their business model, use their balance sheet much more effectively, use distribution to create velocity, adjust, their operating processes, strengthen their operating risk framework. Now, there's another type of regulatory costs, which are change in principles and rules. And that's what Basel III has done, both in terms of evaluation of liquidity, but also allocation of capital. So, for example, the traditional way of valuing liquidity based on historical stability has now moved to a stressed view. And that changes the game in terms of how clients and banks need to build products that are more efficient. Capital requirement on product that can serve the same need for the client will also be differentiated in different capital model. So I think that's where, banks should and, really have a sensible conversation with their client to explain where are those higher costs coming from and what are the solutions that they can put in place to, for instance, channel liquidity to the right product, use the right set of trade finance product to create financing solution, use more, better calibrated credit limit, for instance, and, continue to provide client with a competitive offer while understanding, the potential implication from those regulatory costs.
Right. Okay. So, Jayant, from Olam, how are corporate commodity traders, adjusting to, this entire situation then?
Yeah, so I think it's slightly different for different corporates. I guess, and I agree with both Vivek and Nicola, in the sense that there would be some aspects of costs which may be increasing. So, interest rates may be looking to rise. But I guess corporate balance sheets also have become much more robust, much more stronger now. In a way, unfortunately, what is happening is banks are gravitating towards stronger credits and stronger balance sheets. That is creating an issue for some of the smaller players. And I think Vivek alluded to that as well. So if I were to speak about Olam personally, we have in fact seen cost of financing getting lowered for us over the last few years, as against if I compare that before, say, 2013, 2014. So it's in a way, we have been the beneficiaries of this process which the banks have been following. But to be fair, it's not something which corporates will see across the board.
Okay, and banks, Vijay, DBS, are you guys innovating in terms of products and services?
Yeah, I think the industry is seeing quite a few innovative services and products coming up to not just handle the current situation, Glenda, that you mentioned about a little bit of uncertainty with regards to price and input cost. One of the key areas that we often have been hearing from corporate treasurers is also in terms of managing the liquidity and cash flow through the optimal solution that suits them best, especially when it comes to when dealing in multiple accounts, multiple currencies, multiple countries, and there are thousands of transactions that go through the system. So the traditional approach to this is that the corporate approach various banks, say through an RFP process, and gets responses to that. Now this process can often be long drawn, tedious, and also it may not be able to provide a full visibility in terms of monetizing the cost and benefits and monitoring the same. So in this regard, and you asked for what are the areas of innovations in this in the industry happening. I'm happy to share that DBS has recently launched an online simulation tool. It's a bank agnostic platform, which helps the treasurers to find the optimal solution for their liquidity and cash flow management. So, it also has elements of to handle the challenges that a treasurer faces with regards to a disparate and changing environment of regulations, tax, and other market developments and all. So one, it is free for use, and it is from an industry perspective. And actually, the benefits of optimization coming out of this, on one side, we are talking of cost increase, but this optimality will certainly provide cost benefits as well.
Bhupesh, come into this conversation. So how are trade credit insurers helping clients, just both corporates and banks, to monitor and mitigate the risk and also, participate more fully in the supply chain financing?
Thanks. First, I'm going to talk about Coface as the trade credit insurer here. I think at the very basic level, right, what we're doing is protecting with a level of expertise effectively the lifeblood of our clients, which is the cash flow coming from trade, right? But that's very simplistically put. We like to use this example, which says, most of our clients, all our clients, are very smart at what they do, right? What we're doing is adding value to them. Most people would be very comfortable making the majority of their sales decisions. They've been in the business for a long time. But what's critical now is growth in this environment, right? So what we do is we're actually adding value to that marginal decisioning that is actually going to drive growth, right? So let's call it 10% of the most difficult decisions. We've got 1,000 people in 100 countries taking risk in 200 countries whose job day in, day out is to analyze, process information. We've got information on possibly 70 million buyers across the world. We've got the connectivity. You've seen the expertise we have in people like Carlos on the economic side. We're trying to bring it all together as a specialist service. So we're really a credit management business in a sense. And our insurance is what we do at the end to give them the comfort that we believe in what we're doing. So that has to be there in this environment to be able to give people the comfort that they can focus on their core strengths, which is financing in this case, and in Olam's case, basically getting the product in the right way with the right, processes to the right customers. And we can take a lot of the other, worry about, am I going to get paid for this or not?
Okay. Well, let's discuss input prices here. We want you to also join in this conversation, and we have this vote question for you. So the small little device that you were given just now, if you just take it out again. Now, the question that we have here is the impact of higher commodity prices on Singaporean, what's the impact of higher commodity prices on Singaporean corporates will be? Will it be positive or will it be negative? So you just press the number that corresponds to your answer. You'll have 10 seconds to do that, and the clock's going to start ticking now. Okay, let me see. So, can you see it? So 54% say negative, and 54% say negative, and 46% say positive. Are we surprised by the results here?
Not really, because the impact of commodity prices rising would be different for different corporates depending on where you are. Again, if I were to speak for Olam, we don't really take a direct view on commodity prices. Our profits are not dependent upon taking a view on commodity prices. The business model works on appropriating value from being in the supply chain all through, right from farm gate up to the customer's factory gate. So the absolute commodity price levels do not directly impact profitability. It does have an impact on the amount of working capital we utilize, and indirectly that does have an impact, because the higher the commodity prices, the more deployment you would need in working capital, which is inventories and receivables. But apart from that, and actually most of that cost is a pass-through, typically for supply chain manager, if you're buying from farmers and you're selling to end customers, commodity prices typically take into account the current interest rates and the cost of carry, the cost of insurance, the cost of storage. That typically is a pass-through. So I would actually agree with this, that there is no right or wrong answer here.
Right. Okay. Bhupesh, when demand falls, corporates, they are tempted to, give longer credits. How do insurers then help to navigate corporates during these times?
Look, I think Carlos put some data up, and in our payment survey for 2016, we saw a sharp increase in overdue. This is for China mainly. 64% of the people said that their overdues were more. And compared to, I think it was 26 or 28% the previous year, 38% had at least 2% more than 180 days overdue. At the same time, in 2017, we've grown our exposure, we've done more business, we've supported more of our clients take risk in China, right? So the principle of that is, what is that longer period doing, right? If all it's doing is allowing people to push inventory that may not get sold, then we don't want to be part of that. But what is actually happening is that there's a change, there's a restructuring going on in the market, and if you can separate those from the ones who are taking undue speculative risk, then you can grow your business, notwithstanding the longer lead time and the greater working capital requirement. So we're again, it comes back to the expertise to help our clients manage that.
Niccolo, how do banks engage with all players in the ecosystem to facilitate money is flowing to the right sectors and generating the kind of additional trade flows that we generally want?
Sure. So I mean, the whole supply chain is an evolving space, and there's a lot of changes happening here. I think there's a few forces. One, the complexity of the players in the ecosystem of the client is increasing. And also the client wants to have a much stronger handle on their supplier, on the whole distribution chain as well, and really secure that part. And they're looking for banks to help them through the whole supplier and distributor chain. And that's why somehow the supply chain finance concept is a bit outdated, and we talk about ecosystem now. What that does is actually pushes bank to get into not just the first tier of counterparties that the client is interacting with, but all the way down to the second, third tier. And that comes obviously with challenges in terms of underwriting capacity, risk appetite, product and solution that are relevant to the different tiers of the ecosystem of the client. And therefore, banks need to have a very different type of conversation with client to really understand the whole map of their ecosystem on the supplier and the distributor side. And there is then a significant amount of information and data that needs to be structured so that bank can then feed it back into their risk appetite framework, their underwriting policies, pricing models as well, and eventually, also design product that are relevant to the different level of the ecosystem of the client. So, the real focus is about getting that visibility, adjusting, the traditional model of the bank to be able to, provide the liquidity all the way down to to the different tiers of the client counterparties. And there's also product innovation that's required. Obviously, when you start touching players that are in Southeast Asian countries or African countries, which are not necessarily connected to the banking system, you need to come up with innovation, be it mobile payment, mobile wallet, prepaid card solutions. So it's significant opportunity for banks because it brings the ability to finance all the way through the entire ecosystem of the client. But I think that's where significant investment needs to be made in terms of data gathering and adjustment to the traditional way of doing business with clients.
Right, you mentioned there's some of the solutions, for Vijay, how do banks then help, SMEs access the right levels of support to maintain their business volumes?
Thank you for bringing focus on SMEs in the discussion. Actually, I'll bring certain couple of perspectives here. Notwithstanding, the SMEs are the major generator of employment as well as contributor to the global economy. Historically, availability of bank credit has always been challenged from a sufficiency point of view. Now, if you look at this, all large corporates directly or indirectly buy and or sell through the SME network. And they're a very key part of this entire value chain. But when it comes to a kind of a bilateral trade financing arrangement for the SMEs, often those points of collateral and balance sheet strength or not, those things, from a traditional credit approach point of view, those are the historical issues and all. So even quoting a recent survey by Asian Development Bank, which says that the trade finance gap is 1.5 trillion US dollars. Out of this, 3/4 is for SMEs. And this is on the basis of the trade finance applications which are rejected by the banking system throughout. And to make things worse, most of the respondents in that survey had mentioned that if their applications are getting rejected, it actually means loss of business as well. So it is not that they are finding another place for that. So about 60% actually will lose the business. Obviously, it's not helping out. So a couple of areas I would like to mention in terms of the more innovative ways, but though not very recent. And we talked just now about supply chain financing. So in this entire value chain, where do we the SMEs, because they are on both sides for the large corporate, and the solutions that have already emerged, but the good news is that Asia is adopting it quite significantly now, which is where the SMEs, the help to SMEs, without looking too much into the financial concepts, and but focusing on the transactional flows with the other ecosystem players into that. So that is certainly helping out in terms of helping with the liquidity for SMEs to continue to grow. The other area, which is relatively more recent, is the a collaboration that is evolving between banking sector and the fintech space. So this is, banks are typically heavier weight, relatively slower to move. I'm a banker, so at least we all know about that. But at the same time, fintechs are more nimble, quicker to adopt changes, etc. And also this collaboration is certainly working out, especially to handle and provide the fuel of liquidity even to the tail end of the supply chain. So that is certainly helping out this space.
Yeah, and I could sort of just to step in over there, glad you mentioned about the role fintechs are probably playing in this whole trade finance ecosystem. So if you look at it, as we know that from a bank's perspective, the collaboration really is from a perspective of being able to offer better products and services to their client. But the true power of fintech really comes in when banks are able to collaborate amongst each other also. Because what fintechs are trying, there are two levels at which fintechs are sort of playing, if you just really look at it from a trade and supply chain perspective. One is making it easier for SMEs or corporates who don't have access to finance to avail financing. That has elements of a bit of disintermediation or aggregating of demand for banks to come in and finance. And then the second part of it is how do banks manage that credit risk subsequently by being able to more efficiently distribute it and manage it from a credit perspective. So on both sides, if you think about it, it's really about how do banks collaborate together and not just sort of develop a product for their client. And that, I think, is a bit of a mindset shift in banks. Because even historically, if you look at it, banks have been a large sort of consumer or driver of technology innovation. It used to be, whether it's electronic banking platforms in olden days or procure to pay or EBPP solutions, which were like traditional banking solutions. Banks have always been driving tech, or have been using tech in their delivery of their products and services. What fintech, as we know it today, is really enabling is allowing that collaboration, and that is where it becomes the regulatory part of it, the internal policies, all of that ecosystem needs to evolve to facilitate that collaboration, and that will have a true sort of impact on really transforming both credit availability, liquidity, risk management, and the entire supply chain.
Can I just add one thing to it? I'd just like to clarify, right? This collaboration is great. Banks collaboration has been happening actually for a long time. It can get better with the right tools. But I think what we're also seeing a lot of is an increasing collaboration between credit insurers and banks. It's another way of laying out risk. And when we got two banks here that are really, really good in the region, and we work very well together. The fact is they're extremely good and extremely deep in the markets they are in, but they can never have the breadth that an insurer like us does across the countries that we work in. So that makes it easier to work. It helps them get an investment grade credit backing that helps them manage capital better. It also helps them increase their risk appetite in areas where otherwise there might be issues. So it's a collaboration that goes across many planes.
Right. Well, I want to open up, to the floor now. Do you have any questions? It's quite an interesting topic that we're talking about here right now. Do we have any questions? If you have, just put up your hands, and then our usher will come around with the mic. We don't have to be shy here. We're amongst friends. Okay, well, waiting. We're quite thirsty. All right, so let's wrap up the conversation now. Bhupesh, we've touched on a lot of important issues today. So in this context, do you feel like the credit conditions will improve or deteriorate in the next 12 months? Give us your crystal ball gazing here.
Yeah. I think on the whole they will improve. But you see, life is not about on the whole or the averages. It's about what I said, the marginal ones. And the biggest concern I have right now is all the indicators of the good things happening are things like fuel prices going up, interest rates are going up. What's happening to input prices and the pressures that they could have on people who don't manage their end-to-end cash flow cycle well. So that's where it comes in and says, if you can get to manage that well, then I think it's going to be a good time because demand is going to get better. So it's a question of making sure liquidity problems do not arise because you have not managed your cash flow well. So I think that's my view.
All right, thank you very much, gentlemen. And it's a very illuminating conversation. I hope it sheds some light on managing business risk as commodity prices and interest rates reset. Once again, we've come to the end of today's panel discussion. I would like to thank my esteemed speakers and panelists here. And if I could invite you to take your seats as well. Mr. Bhupesh Gupta there from Coface, Mr. Vijay Vashist, DBS Bank, Nicola Langlois, Standard Chartered, Jayant Parande, Olam, and Vivek Gupta, CCRManager Private Limited. Thank you very much, gentlemen.